Hello, everyone. Happy Monday. Thank you for coming to our weekly live webinar trainings. Today, it's all about bear call spreads. And you're like, Uchenna, what is that? Guess that's me. I'm Dr. Uchenna Cole James, pharmacist and badass stock options trainer. Thank you for everyone who came out to join me today. Much appreciated. Today we're all talking about bear call spreads and what to do when the market has a pullback. How to still get paid. Because bull bear, we don't care. Options traders make money whether the market goes up or down. Let's go. So thanks for joining me today. A few housekeeping notes before we jump in. Drop your city in the chat. Where are you from so I can know where you're joining from. And also put your questions in at any time. You don't have to wait to the end. I'm here for you. So thank you for joining me today. I'm so happy that you took the time out of your Monday to be here with me. So don't wait to the end. Put your questions in. Grab a notebook. Grab a pen. Take some notes. Let's get going. Okay. You're going to want to write down these three S's tonight. Trust me. I got some good stuff for you guys. And the replay comes tomorrow. If you registered for this webinar, you're going to get the replay. It's also on my YouTube channel. Make sure you like, subscribe, so we can keep this party going. I want to make sure that this is the content that you want to see. That's me. Pharmacist, trader, educator. As many of you know, I've been trading for over 10 years. And let me tell you, I've had my ups and my downs. And I've shared a lot of my ups with you. And of course, I've shared a lot of my downs. And over time, I have realized that in order to be successful in this trading, you have to build your own system. My system may not work completely for you, but at least I give you the tools that empower you to build your own system because you need a trading system. What is a system? A certain setup, right? When do I enter? How do I manage? When do I exit? How much money am I going to spend per trade? That's basically what your system should have. What to trade, when do I exit, how much do I risk? Asking those four questions will allow you to trade another day, baby, because that's what we're here. I'm here for you, queen. I'm here to empower you to gain a financial lifestyle that you've been looking for by trading stock options. Today, it's all about bear call spreads. Let's get started. So, what you're going to walk away with tonight, three things: what a bear call spread is, and of course, when to use it, right? Last week we were talking about all about bull put spreads. So this basically is the flip side of a bull put spread. That's what we call bear call spreads. Okay. So this is what to do when the market is flat or has a little pullback, meaning it starts to go down because it's rallied so much. And if you are trading today, you know that the market has been on a tear. So I'm going to show you when this particular strategy is apropos to your portfolio. The three S's for my bear call. That's my system in one hook, okay? Sell at resistance, sell 30 delta, and set the limit. You already know the rhythm because that's what we talked about last week for our bull put spreads. The three S's for that particular strategy. Today's the three S's for the bear call spread. And how to spot a real resistance level, not a fake one. The chart pattern, I'm going to show you what that looks like when the stock is about to pull back, not just pausing. Let's go. How I trade, like bull, bear, we don't care, right? Options traders make money when the market goes up and when the market goes down. So that's the benefit of being a retail trader. We're nimble, we're quick. We can get in, we can get out. And if it's a favorable enter, then let's enter, make some money, collect those profits. If it's unfavorable, that we take a small loss. We don't want to take losses that blow up our account. So money management, risk management is always key. So these are the different strategies, some of the different strategies that you can put on depending on what's going on with the market. Okay. When the market is extremely bullish, meaning going up, you usually want to get in a long call because that's what you get in when you want to make money when the market's going up. Bullish to neutral. So when the market's going up and then it's like kind of like flat, that's when you put on bullish vertical spreads. Remember, we talked about the bull put spread last week. There's also called a bull call. We haven't discussed that yet, but definitely bull put spreads. Make sure you check out my YouTube video of the bull put spread. When the market is neutral, you put on an iron condor. That's a combination of a bull put and a bear call spread. When a market is bearish to neutral, you can put on a bearish vertical spreads. Those are the bear put or the bear call. Or if the market is extremely bearish, selling off, that's when you want to place the strategy, the long put. Today, we're talking about the bear call spread. So, this is some tea, pro tip. Most options traders are spread traders, or most successful option traders, maybe not most. A spread is a strategy that involves taking opposite positions in the stock. One position gains value while the other position loses value. But successful option trading is capturing the probabilities. We want to make sure that we manage our risk appropriately. That's why it's important to have some spreads in your portfolio. Okay, they create higher probabilities of success. One option is purchased, one option is sold. Both are the same type, either calls or puts, and expire at the same time. Today we're going to talk about the calls. So what is a bear call spread? It's a premium seller's trade for when a stock has run too far, too fast. You sell a call at one strike lower, and you buy a call at a higher strike, same expiration. You collect the credit up front. Remember, when you sell something, you collect premium, you collect money from that. So that is the credit for putting on this trade. It's a credit strategy. You receive money for building this type of strategy. The credit is yours if the stock stays below your short strike. Okay, this is a more bearish strategy. The max profit that you receive is the credit that you receive. So the credit that goes into your account immediately when you put on this trade is the maximum amount that you can make on this strategy. The max loss, so the maximum amount that you can lose on this trade, is the width of the spread minus the credit. Okay? You win when the stock goes down, stays sideways, or goes slightly up. You lose if it rallies through your short strike. So if a stock rallies, that means it's very bullish. If it goes up and it breaches your short strike and then your long strike, you're at a max loss for the trade. Okay, so we want to maximize our profits. We want to be able to set this strategy up in a way that we make money. So we put it above an area called resistance. So this is a bearish, defined risk trade. It's the perfect trade for stocks that are bumping up against resistance. And this is our profit loss graphic of what the bear call looks like at expiration. You sell a call, and at the same time, you buy a higher strike call. You collect a credit. You profit as long as the stock stays below your short strike. Once again, just look at the right side of this slide, the credit spread, bearish vertical credit spread. I'm usually in them for 1 week to 1 month. It's a bear call spread. You buy a higher strike call out of the money. You sell a lower strike call out of the money. So the entire trade remains out of the money. Remember, As a seller, you want your option to stay out of the money. That's how you make time. You make money based upon time. You make money of the stock staying, this particular strategy of the stock staying below your out of the money strikes. Okay. And most options finish out of the money. So selling options is a more profitable strategy than buying options. You receive money for placing this trade. That money that you received is in the form of a credit. You want your option premium to decrease so you can buy it back at a cheaper price. You make money based upon time. Higher probability, lower risk trade. Your driver is your short call. Long call is for protection. Once again, this is the way the setup looks. It's mildly bearish to neutral. Remember, you make money if the stock does three things: goes down, stays neutral or sideways, or go up just a little bit without breaching your short strike. I'm going to show you what that looks like on our wonderful platform, Thinkorswim. So what are the entry rules? Number one, sell the strike you expect the stock to be below at expiration. Buy the higher strike depending on the spread risk. Buy high, sell low. Exit rules. Favorable exit is 80% of our premium. Sure, you can keep the strategy, your bear call to expiration. However, I like to make money in my sleep. I always set a limit order to get me out at 80% of the premium that I receive. It's just a pro tip. That's what I found. I'm able to keep more money into my account. Okay. And your unfavorable exit is a 50% loss. Because the risk to reward is skewed, you never want to take a max loss on this trade, because one max loss literally can eat up 4 of your gains from this strategy. So just as you're quick to enter, depending on how much time you have left in the trade, you want to be quick to exit as well. Okay, so I'm going to show you. Oh, sorry that my graphic got a little skewed. But okay, so let's say you have a $50 stock, right? You buy a $60 call out of the money, you sell a $55 call out of the money. That total credit that you receive is about $2. What is your spread? Your spread is the strike, the $60 strike minus the $55 strike. That's a $5 spread, right? So your spread is $5. The total credit you received is $2. What's your maximum loss? $3. That's why we never want to take a max loss on these trades, okay? So copy down this slide. Write it down. The 3 S's. Same rhythm as bull put spreads, but it's a different anchor, okay? Number 1 S, sell at resistance, okay? Enter when the stock hits a real resistance level and rejects it, not when you feel it, when the chart shows it to you. You also want to sell the 30 delta. What does that mean? A 30 delta is a 30% probability that your stock is going to end up in the money, like at that strike. We don't want it to be in the money. We want it to stay out of the money. That's how we make money on our bear call spreads. So that's why we sell at 30 delta. The probability, 30% probability of being in the money. However, 70% probability of being out of the money. And those are the probabilities that we're aiming for. Sell the call at a 30 delta. Higher probability the stock stays below and you get a healthy premium. And also, as soon as your order is filled, you want to immediately put an opposite order to get you out at 80%. GTC, meaning good to cancel. Trust me, you're going to make so much more money that way. Let me show you what that looks. So, how do I spot a real resistance? The chart pattern that tells you that a stock is done running, okay? So key points. You want to look for a price level that the stock has hit at least twice and rejected. Once really isn't a level. Twice starts to matter. 3 times is definitely real. Sometimes we don't have 3 times. I usually just do twice, okay? You also want to check the 50-day and the 200-day moving averages. Resistance above both is stronger than resistance below. Why? Because resistance above means that the stock has rallied up. Resistance below means that there's been a lot of selling to the point where now it's below the average 50 days and the average past 200 days, okay? Watch for a lower high after the resistance test. That's the confirmation that the stock is rolling over. Volume always matters, okay? Rejection with high volume is the market voting. Rejection on low volume can fake you out. That's what we call a bear trap. Don't fall into the bear trap. And also, don't enter, this is my own personal rule based upon thousands of trades that I put on. Don't enter within 4 weeks of earnings. Earnings surprises destroy bear calls even faster than bull puts. So how about we take a look at some charts? I'm going to show you what I use to trade. So this is my chart. It's a practice account. What we have out in front of us is 1 year, 1 day on NVIDIA. Okay, so I'm going to show you what to look for our bear call spread. This to me is right. So what happened here? I'm going to draw this out for you. You had a strong bull run, then it had a little bit of pullback, then a very, very strong bull run into earnings, right? Then you had a sell-off here, and then it bought it back up. It could not hold the buying. Then the sellers took over, got back in control, and sold it down. This is also an M for murder. So let me show you where the resistance levels are. Resistance would be right here, around 229, 230-ish. This resistance level hit this, it hit the resistance level on May 18th and also hit it on June 2nd. Once I saw this hit this resistance level on a higher than normal volume, this is when I put on my bear call spread. Put this in pink. So this is bear call territory. Mind you, this is a daily chart, okay? So if I'm using a daily chart, then I usually like to stay in the trade for 2 weeks to a month, okay? Let's put on a smaller time frame so you can see the way that looks. But if you look at it, I have a high after a very strong bullish run, right? Very strong. I have a high, then this is a lower high. So this high on June 2nd is a lower high than May 14th. This is a good signal to put on a bear call. This is called a lower high. Once it closes below this low of the high day, that is my trigger. So I wouldn't get into this bear call until the end of the trading day. Okay? I hope you took notes on that. We can do a 20-day, 1 hour. Oh, no, we want to go further back than that. Let's do 6 month, 1 day. Same thing, right? You got a strong rally from this day here, March 30th, until about April 22nd. It was a full month, full bullish month. Then you get a couple, 1, 2, 3, 4, 5, 6-day pullback. And then you have another strong run from May 5th till May 14th. So it's like a 2-week run, right? Almost. So very strong. Slight pullback, very strong. Okay. Then the market makes a high here, makes all-time high here. Then pull back. The buyers try to get in back in control, but the sellers are like, no, no way, forget it. And they sold it back off. When you see this lower low, put it like right here, those 2 days. When you see this lower low from this high here to here, that this, and you see this wick on the top where the sellers like really got back into control strongly, go against the wick. This is where I put my bear call spread. How do I set it up? I set it up where it's way above resistance at a 30 delta. So the call that I sell is like here. The call that I buy is here. So this is a setup on my bear call spread. All I need the stock to do is go down. I make money, stay flat. I make money. If it goes up a little bit, that's okay. But then after it goes up, I need to stay flat or go down. If the stock does like this, I lose money. Okay? We don't want to take a max loss on our bear call spreads. We want to sell it above resistance. Where is resistance? We stated resistance was 230. So I would put my bear call around 237, 240 for my short strike. I would want to get a 30, sell at a 30 delta so I can get, a little bit of premium. I want to get a significant amount of premium. And as soon as I enter and it gets filled, I put an order to get me out. So let me show you where that look. The reason why I wouldn't do one today is because I haven't had a lower high. So look at today. NVIDIA, oops, change this color. NVIDIA had a high, then it stayed flat, it went down, then it had a higher high. So this high is higher than this high. I don't want to put a bear call on here. I want to put a bear call when I have a lower, I have a high lower than this high. So this is bear call territory, not this. It's very important, okay? So let's see if I can find a stock that's in bear call strategy. This is not in bear call strategy because I would not put a bear call on, this is Apple, because of this run up here. You had this run up, you had an earnings report that sold it off, and now it's just trying to find its footing. If anything, Apple wants to fill this gap. So remember, you don't want to put on a bear call strategy on a stock that's going to rally a lot, that a stock that's going to go up a lot. Okay. Definitely not bear call strategy time. Okay, look at this behemoth. If anything, if anything, I mean, it's hitting resistance now. Look at that. It's had some resistance from November last year, around 515. And that was actually the high. Let's see what the high was for today. The high for today was 513. So Microsoft is hitting a resistance level right now. I would need to see this. And this is where I would put a bear call on, right here. I need to see a lower high. Okay. We can go for bowling. Nope. Here was a lower high after this big run up. Then you had low, and then you had this lower high. This lower high is a trigger to put on a bear call spread, and you would have been rewarded handsomely. Um, let's see if I can find a failed bear call spread. Let's see. One that fit you out. A lot of earnings. Yeah, I mean, look at this one. Seagate. This is a bear call setup. High. Then this is a lower high. Then that's when you put on the bear call spread. Okay. Let's see. What WBC. This had earnings, and you don't want to put on your bear call spread by earnings, but when you have a higher low, uh, yeah. When you have a lower high, this is beer call spread territory. Okay. Let's see. Nope. That doesn't look like any. This is perfect for bull put spread. Look at this. Remember what we talked about last week? So this is an uptrending stock. I only put bull put spreads on uptrending stocks, and I only put bear call spreads on downtrending stock. Downtrending is lower low, lower high, and let's see if we can find one. Let's see my watch list. Oh, this is all over the place. Yeah, this is a good one. Look at Tesla. Had a high, lower high. Then this broke through, but depending on how much time you have your trade and when you got in, it still was successful. So downtrending stocks is what we're looking for. We want a high, low, high, low, high, low. Want to be able to draw that arrow. That's that's the time here is when you put on the bear call. Okay? I don't see anything for here. Google. No. I mean, you could have done something here. Oops. After it ran up like this and moved sideways, start to pull back. This low is lower. Here's where I put on my bear call spread. Okay. Amazon. This low is lower than that high. I don't know if I would have put on a bear call spread. I probably would have waited to this candle here with this gap down. Once it gapped down like this, that's like high conviction for the sellers, this big gap down. This was the day that I put on my bear call spread. Very bearish right here. Yeah, it's bear call season here. You zoom in. Bear call season would have been here. this high, then you have a pullback, lower high, into the bear call. And the setup looks like this. You buy high, sell low. So this is the setup of your bear call spread. And it's on the call side. How will we set that up? Let's see. Is this the stock I want to use? No, I don't want to use this. Let's see. AMD's looking right for a bear call spread. Yes, it is. AMD's looking right for a bear call spread. So you had it rally up, then it kind of stayed flattened out, and then it made this lower high. Kind of made this lower high, sold off, rallied up, and this is a lower high. So the day to put the bear call spread would have been August 5th. And all you need to do is go down, stay flat, neutral, or go up just a little bit. So this is the day we would have put it. It would have looked like this. So it could go here, here, just a little bit here. Yes, it'll go this way. If it breaches this short strike, you start losing money. If it goes above the long strike, it's a max loss but at expiration. So you definitely want to exit before you get a max loss, preferably 50% of the premium that you receive, okay? At 50% loss, okay? So AMD is one that I would have a bear call on. Let's put that on now. The market's closed. Remember, the market's open from 9:30 to 4 Eastern Standard Time. So let's see how many days. I'm looking at a 6 month. Look at a year. I would put on a bear call until August 21st. Let's see how much I can get for a 30 delta. So August 21st. It's only 11 days, but that is a busy expiration. So remember, look at the call side. Where's your 30 delta? 30 delta is at 500. Okay, so let's look at where that is on a chart. 30 delta is right here. To be exact. So that's the setup. I would sell the 500, sell at the bid. So my trade will look like this. I would, depending on how much money I could get for 250, I love 250 wide spreads. I love them. So let's say buy at the ask. Oops. Hold the control. Click the bid at 500 because that's my 30 delta. $57 credit. So I like a 30% reward to risk. 57. So let's start. The spread is 250. Minus that by the credit. It's 193. So my reward to risk is my reward is 57 divided by 193, which is 30. It was about 30%. I'm cool with that. So how much can I afford to risk? $1,000 on this trade. That means I can't afford to buy more than about 5 contracts. See if I can get filled tomorrow. So make sure it's in your monitor tab, working orders. So when the market orders opens tomorrow, if it likes where this credit is, it's going to fill. I'm definitely going to take a look at it tomorrow, first thing, to see if it fills. But I like to put my spreads on between 3:30 and 4, the last 30 minutes of the trading day. Okay. Hope that was helpful for you. Let's go back to our slides. So how do we spot real resistance? You look for a price level that the stock has hit at least twice and rejected. Remember, we saw that in all the examples. You watch for a lower high after the resistance test, and that's the confirmation that the stock is rolling over. You can check the 50 and the 50-day and the 200-day moving averages. Those are natural resistance levels, and resistance above both is stronger than resistance below. Volume really matters. Rejection, so if it failed to get above resistance on high volume, the market has a high conviction to sell. And don't enter within 4 weeks of earnings. Okay. Number 1, for bear calls, close below the low of the high day. Make sure you wait for that confirmation candle. If today doesn't close below yesterday's low, then wait. You'll get your opportunity. Just look for another stock, just like I did. It took me 7 stocks to find the one that I wanted, but that process literally was less than 5 minutes. Okay. Never enter on the resistance touch alone. Wait for the confirmation. Wait for that candle that's sold off. Number 2, no earnings within 4 weeks. Do not put a bear call spread if earnings are less than 4 weeks away. An earnings pop above your short strike is the fastest way to hit max loss. Set the stop in the platform at entry. Okay. I like to set my stops at 50%, but I do this if I have time left in the trade. So if I'm putting on a bear call spread for like a month, then I'm putting my stop in the last 14 days of the trade. I want my trade to work. I want to wait for my trade to work. Okay. So if I'm selling the 25 to 35 delta, I set my limit at 70 to 80% profit. Delta, if I'm want to be more aggressive, then I sell a higher delta, 35 to 50. Then I'm going to set my limit to get me out at 50 to 60. Don't be greedy, guys. I'm trying to tell you, base hits, 100 out or 25% here. I like 30%, 30% here, 30% here, 30% here on every trade. So you can live to trade another day. 1% risk per trade, max 5 to 10% per symbol. Okay. Any one symbol under 30%, or any one symbol 5 to 10%, max under 30% of total portfolio heat. So I usually don't have bear calls on that's more than 30% of my portfolio at a time. Okay. So if I have $100,000 in my account, I don't tie up more than $30,000 on bear call spreads. Okay. After a big winning month, cut your position size to 50% for the next 30 days. Protect gains, don't chase. Because if a stock has run up, right, and then it starts to sell off, it hits your resistance, that's when you put your bear call spread. That's when you really want to get in, like that's when your trade is more likely to be successful. And if it keeps going down, it has another run up, the odds in this particular market of the next month bear call are being successful are slimmer. So don't take on the same amount of risk for that second month of your bear calls being successful. Okay. I like to exit Monday, Tuesday, Wednesday before expiration. Weekly spreads can go to expiration only to the last day. Okay. Buy a lower strike, sell a higher strike is always bullish. Buy a higher strike and sell a lower strike is always bearish. As the strike prices are further away from us, so the wider the spread, we looked at a 250 wide spread on AMD. The wider the spread becomes more bullish or more bearish. A $5 spread on AMD is more bearish than a 250 spread. Okay. It's also more money you can lose, right? The wider the spread, the more risk in a trade. 3 things for you to remember. Sell at resistance, sell at 30 delta, and as soon as you get in that your trade is filled, set your limit order to get you out at 80%. Bull put plus bear call doesn't matter. You can get paid whether the market goes up or down. That's the whole game of being an options trader. Make sure you have bull puts and bear calls in your portfolio. Find the right stocks. You don't want to just have all bull puts or all bear calls. Try to put a mix in your portfolio. Okay? And remember, I always have my options mastery beginners trading course for $4.97. And if you want to go deeper with me, want me in your corner, I have a private coaching program. Basically, it's learn how to trade in 90 days. I will hold your hand through the process of you becoming a badass trader like me. Thank you for joining me today on my Bear Call Spread webinar. Make sure you come back next Monday. I'm here for you. Same time, 7 p.m. This is free. Bring a friend. I dedicated this time to you. Come learn. Thank you. I appreciate you. Remember, bull, bear, we don't care. Options trader makes money when the market goes up. Oh, when the market goes down. Let's get paid.